Simon Cox, Managing Director and Investment Strategist at BNY Mellon Investment Management. When it comes to strategy, it's kind of hard to figure things out right now. It's a very volatile market.
It is, but I guess in some sense the bond market puzzle that we've been wrestling with over the last year or so has become less puzzling. In some sense the conundrum was why are American bond yields so low, given that the recovery seemed to be gaining traction and the Fed was talking about raising rates. And now we've seen a rise in bond yields, not to very high levels, but at reasonably quick pace. So in some sense the puzzle is unraveling itself.
It is, but of course it's now all about timing. And how do you gauge that when it comes to where you put your dollars and in which parts of the world do you do that?
That's right. So I think, particularly in this part of the world, you want to be looking at markets that are reasonably robust to tighter monetary conditions, to bond yields rising in the mature economies. So you want to be looking at economies that have a reasonably good current account balance and where inflation is under control. They tend to be more North Asian than Southeast Asian as a rule.
Okay, I mean, case in point today is Japan. We've got a current account surplus that is pretty significant here. And it really is a beneficiary of what? Lower oil and, of course, the yen. It's weakening. And so, I mean, Chinese tourists are flooding in to Japan.
So again, I think it's another case in which a puzzle that we've been living with has become a little less puzzling. For a long time, people have been wondering why exports didn't show a stronger response to the weak yen. And I think, if you look back over history, it's often the case that these very big realignments of the currency take time to feed through. Because it's not just that existing factories ramp up production,
right.
It's also that firms change their location decisions for where they put production. And so we've seen a number of firms in Japan looking at increasing capacity in Japan, rather than just relocating everything to cheaper countries elsewhere.
I want to ask you about how Japan factors into your most recent white paper at BNY Mellon. That looks at what might happen if Japan, India, China, America all reach their best, fullest economic potential at the same time.
That's right. So it's a slightly contrarian, optimistic scenario.
Right.
And we're looking at these economies doing reasonably well over the rest of this decade. So leaning against the view that we're resigned to new mediocre or to secular stagnation. And the reason we're looking at that is because it's really quite unusual to see all three of Asia's big powers with such secure governments all at the same time. And all three of those governments, Xi Jinping in China, Shinzo Abe in Japan, and Narendra Modi in India, they have mandates and they have at least good rhetoric
and they have reform mandates too, right?
That's right.
Specifically.
And of course all of them are facing problems in implementing that reform, as we've seen just this week in India with the goods and services tax being tabled and the land bill really getting nowhere. It's not a particularly good week for structural reform in India. But there's another reason why we're looking at an optimistic scenario, and that's the view that all four of these economies are currently operating below their full potential. The view that recent economic weakness has left these economies with quite a lot of slack and quite a lot of room to grow before they start running into capacity constraints.
I guess when you think about slack, all of this cheap money is flowing about, and the companies have not invested in itself. No capital expenditures, less than anticipated. More so stock buybacks and dividends.
Yes, that's
it really
right.
is just an accounting thing rather than an investment.
And that's been particularly true in Japan over 10 years or longer. I mean, it's extraordinary to look at the financial assets that corporate Japan has accumulated during the deflationary period. But of course, all of that can begin to change. If inflation does pick up in Japan, if demand and sales start picking up, then firms will be looking to do more interesting things with their money rather than just parking it in the bank. And then we might see actually quite far-reaching changes in Japan's economy. It could become one in which the corporate sector borrows and spends rather than hoards.
Well, yeah, I mean, that has been the central bank's hopes around the globe, whether or not realistically that happens on a base level. But of the G4 countries that you noted there, which one has the greatest potential to reach escape velocity?
Well, the fastest growth rate amongst the four that we're envisaging would be India. We're envisaging a growth rate of about 8% on average over the course of the decade, and that's driven partly by demographics, partly by the fact that India is still a very poor economy, in which even quite modest reforms would yield rather big dividends. And it's also because India's coming out of a period of quite nasty stagflation, in which they had this very persistent inflationary psychology, which they do now seem to have beaten, which has allowed the Reserve Bank of India to be a little bit easier with its monetary policy, and it's also allowed Arun Jaitley at the Finance Ministry to start thinking again about investing in infrastructure there.